If your portfolio isn't mapped to your next 1, 5, and 10 years of life, it's not a plan, it's a hope. Benchmarks don't pay for college. They don't fund your lake house, and they definitely don't cover your sabbatical when you finally decide to downshift. Cash flow does. And today I'm showing you how we build portfolios from your life backward so that you can actually live your version of a rich life without wondering if your money will be there when you need it. I'm Dan Pascone, founder of Tailored Wealth, and we help executives and business owners to optimize wealth, reduce taxes, and build portfolios that actually serve their life goals, not some arbitrary benchmark. And if you're earning $500K or more with multiple goals and a family that's counting on you to get this right, this video is for you. Here's what drives me crazy about traditional portfolio management. Most advisors build portfolios to beat a benchmark and use a subjective, feelings-based questionnaire to figure out your allocation. On a scale of 1 to 10, how do you feel about volatility? Well, here's the reality. Volatility isn't your real risk. Your real risk is not having money when you need it. Your real risk is having to sell long-term investments during a downturn because you didn't plan for short-term needs. Your real risk is failing to meet a commitment, whether it's your daughter's college tuition, the down payment on your vacation home, or being able to step away from work on your terms. So let me reframe this for you. Risk is personal. It's not a score on a risk tolerance quiz. It's whether your money shows up for you on time for your life. This is where life-driven investing, or LDI, comes in. In the institutional world, LDI stands for liability-driven investing, which essentially means endowments and pensions matching assets to future payments. But for families, we reframe it as life-driven investing, matching your assets to the timing, magnitude, and purpose of your future cash needs. We're not chasing a benchmark. We're matching your assets to your life. And at Tailored Wealth, we call our process TAMI, Time Horizon Asset Management Integration. It sounds fancy, but it's actually pretty simple once you see it. Here's how it works. We start with the 4 time bands that cover your entire financial life. Band 1, 0 to 2 years, your current needs. This is your cash management sleeve. 6 to 12 months of living expenses and an emergency fund, and any upcoming purchases that you know are coming. This money needs to be liquid and stable. Think high yield savings, money markets, T-bills, zero drama. Band 2 is 3 to 5 years. These are your short-term goals. This is your conservative income sleeve. Maybe it's your lake house down payment in 3 years. Maybe it's a home renovation or funding a future business expansion. We use short to intermediate term bonds, laddered treasuries or munis, and high-quality credit. Stuff that won't blow up when you need it. Band 3 is 6 to 10 years. These are your midterm goals. This is your moderate sleeve. College tuition that starts in 6 years, or maybe a phased retirement where you downshift in 8. Now we can add diversified equity, quality bonds, or maybe buffered ETFs for a smoother ride. We're growing this money, but we're not swinging for the fences because we know when we need it. Now, band 4 is your long-term goals. Think 10 plus years. This is your aggressive growth sleeve. Think full retirement, legacy planning, your kids' inheritance. This is where we can lean into global equity. And for high earners with long-term time horizons, even select alternatives like private equity, private credit, and real estate. Now, here's the key question that we ask for every single dollar. What's the cost to access your money? Not just the asset class, but what's the account type, who owns it, what's the tax treatment, and the withdrawal schedule. That lens changes everything. And once we know your time bands, we get tax smart about where we hold what. This is called asset location, and it's one of the biggest levers you have. Here's how we typically structure it. And I say typically because your situation will be unique. Taxable accounts hold cash management and short-term duration stuff for liquidity. Muni bonds if you're in a high tax bracket, a diversified equity core with tax loss harvesting opportunities, and alternatives if they fit, but just make sure you're aware of K1s and tax complexity. Pre-tax accounts like your 401k or traditional IRA, this is where we put income-heavy investments that would create ordinary income if they were held in your taxable accounts. Think core bonds, income sleeves, things you'd least like to pay taxes on an annual basis. Now, Roth accounts. This is your highest growth, longest time horizon bucket. Tax-free compounding for decades. And we're aggressive here because you'll never pay taxes on the growth. And if you have an HSA, this can be your medical endowment, which is triple tax advantage if used for medical expenses. Now the withdrawal strategy. Now, we have a few options depending on your situation. Option 1 is the cash first refill. You spend from your 0 to 2 year sleeve, and once a year, we refill it from the longer term sleeves based on your plan. Option 2 is tax bracket aware. We blend taxable withdrawals with partial IRA distributions to fill your tax bracket efficiently. If you're charitably inclined, we layer in qualified charitable distributions or donor advised fund strategies. Option 3 is the sequence defense mode. When the market's down, we pause long-term sales and we pull from your short and intermediate bands because that's what they're there for. We harvest losses in your taxable accounts to create future tax savings. And when the market recovers, we rebalance everything back. And here's the beauty of our approach. We manage your portfolio at the group level, so all of your family's accounts are managed together. That means we align risk holistically, harvest tax losses strategically, and rebalance post-withdrawal so that you're never out of whack. Now, if you're a high-earning executive, you've got another layer. Equity compensation. RSUs, stock options, employer stock plans, these are often the biggest levers in your financial plan. And yet most people are winging it. Here's how we integrate equity comp into the life-driven framework. RSUs or restricted stock units. We treat these like cash compensation with equity risk. Sell to cover at vest to handle the taxes automatically. Then we route proceeds to your time bands based on your near-term goals. Maybe 40% goes to your 0 to 2 bucket, 30% goes to 3 to 5, and the other 30% gets dollar cost averaged into your long-term bucket. No emotion, no guessing, just a system. ESPP or Employee Stock Purchase Plan, consider immediate sales to diversify and deploy the proceeds to your shortest underfunded band. Concentration risk is real, and company stock doesn't care about your goals. Stock options like ISOs and NSOs, this is where tax planning gets critical. We coordinate around AMT windows for ISOs and use 10b5-1 plans to automate sales and remove emotion. And we manage expiration timelines so you're not scrambling at the last minute. We've helped hundreds of executives navigate these decisions, and the difference between winging it and having a playbook could mean millions over the course of a career. Now let's talk about the biggest risk that any investor faces. Sequence of return risk. Let me show you why this matters with a quick example. Meet investor A and investor B. Both have $2 million portfolios. Both average 7% returns over 10 years, and both need to withdraw $100K a year. But the order of their returns is different. Investor A experiences returns in this order: down 20, down 10, up 5, up 12, up 15, up 8, up 10, up 7, up 6, up 18. And investor B has the exact same returns, just reverse the order. Same average, different sequence. And at year 10, investor A has $800K less than investor B. Why? Because investor A was forced to sell assets in years 1 and 2 when the market was down, and those dollars never recovered. Now, here's the life-driven difference. Investor B had 3 to 5 years pre-funded in conservative sleeves. And when the market tanked in years 1 and 2, they didn't touch their long-term portfolio. They let it recover. By the time they needed to refill their near-term bands, the market had bounced back. That's not luck. That's planning. Having near-term liabilities covered reduces forced selling and keeps long-term growth compounding. Now let me bring this to life with a real example. The names were obviously changed for privacy. Meet Jen, who's 45, and Mark, who's 47. Their combined income is roughly $900K a year. Mark has RSUs that vest quarterly, and they have 2 kids ages 8 and 12. They're eyeing a lake house in 3 years. They have college that starts in 6 and 10 years, respectively, and they'd like financial independence by year 12. This is the classic multi-goal household. And when they came to us, everything was in a balanced 60-40 portfolio across all of their accounts. No time horizon mapping, no tax strategy, no equity comp playbook, just a generic allocation. So here's what we did. We funded their 0 to 2 year band with their living expenses plus a healthy emergency fund. We built the short term band specifically for their lake house and laddered munis and short term bonds. Then we positioned their 6 to 10 year band for college with a mix of diversified equity and bonds. And we kept their 10-year plus band fully invested for long-term growth with some allocation to alternatives for added diversification and upside. And on the RSU side, we automated sales, rerouted cash to different time bands, and harvest losses when available. We also set them up with a donor-advised fund for appreciated shares since they're charitably inclined. The result? The money for the lake house was never at the mercy of a bad quarter. College funding is on autopilot, and they've got total clarity on what they can spend today without jeopardizing tomorrow. That's the calm that comes from life-driven investing. All right, let me finish with some actionable steps you can take right now. Step 1, inventory your next 1, 5, and 10-year cash needs. Get specific. When do you need the money? What is it for? And how much? Sort every dollar by when you'll use it and what's the cost to access it. Account type, tax treatment, account ownership. It all matters. Step 3 is map your current holdings to time bands. Where are your gaps? Are you overfunded in long term and underfunded in short term? Step 4 is to set refill rules and drift thresholds for rebalancing. When does a band get topped off? And what's your tolerance for drift when you rebalance? And step 5 is to automate equity comp decisions where possible. 10b5-1 plans, DCA rules, pre-vest routing, remove the emotion. Let's bring this home. Life-driven investing reframes risk from volatility to failure to meet commitments. And it funds your near-term needs so you're never forced to sell long-term assets. It optimizes taxes through smart asset location and withdrawal sequencing. And it protects your long-term compounding because your growth sleeve gets to do its job, uninterrupted. Your investments should have a job description tied to a date and a purpose, not a benchmark, your life. If you want this mapped out for your specific situation, visit yourtailoredwealth.com and see if a wealth clarity chat is right for you. It includes a life-driven portfolio assessment where we'll walk through your time bands, your tax strategy, and your equity comp. And hey, subscribe to the channel and drop a comment below with your top goals for the next 3 to 5 years. I read every single one and I'll reply with how it fits into your bands. I'm Dan Pascone with Tailored Wealth. Thanks for watching, and I'll see you in the next video.